Hello friends, this is Hatim Rampurawala, and in this video we will revise chapter number 10, that is aggregation of the income, set off and carry forward of the losses. This revision we are doing directly from the ICI module, and in this we will cover all the illustration as well as the exercise part. So let's begin, and it will be a quick revision of the illustration. Let's start illustration number 1. Mr. A, aged 35, submitted the following information, following particulars pertaining to the assessment year 2021. Income from the salary computed. Okay, loss was self-occupied. Self-occupied property was 70,000 rupees. Loss from the let out property was 1,50,000 rupees. Loss from the business was 1 lakh rupees, and bank FD was 80,000 rupees. Compute the total income. Simply we will see what can be set off against which income can be set off against which income. So salary, so it is income. Then loss of self-occupied house property can be adjusted against the salary. 70,000 can be deducted. Then let out property loss can be deducted against the salary income. Then business loss cannot be deducted from the salary income. Business, it cannot be set off against the salary income. Then this business loss can be set off against the FD income 80,000, and 20,000 will be carried forward. So we will see. And this house property loss can also be set off because the provision state that we can set off only till the amount of 2 lakh rupees. So over here the house property loss is 1,50,000 plus 70 is 2,20,000. So only 2 lakh can be set off, and 20,000 will be carried forward for the next period. Next assessment, next assessment here. So it is like, okay, 4 lakh was salary income minus 2 lakh rupees, so 2 lakh income, 80,000 minus 1 lakh rupees, so it is nil, and in this case 20,000 will be carried forward against the business income of the next assessment year. In house property also, balance of loss of 20,000 rupees from the house property to be carried forward for the next assessment year. Perfect. So only 2 lakh rupees will be taxable, that is it will be the gross total income, and deduction is nil. Haven't been provided. Total income is 2 lakh rupees. The gross total income includes the salary income of 2 lakh rupees after adjusting 2 lakh rupees from the house property. The balance of 20,000 rupees of the house property is to be carried forward to the next assessment year for the set off against the income from the house property of that year. Business loss of 1 lakh rupees is to be set off against the bank interest 80,000 rupees, and the remaining loss of 20,000 will be carried forward, and it cannot be set off against the salary income. Perfect. We are done with that illustration. Now illustration number 2. A resident individual furnishes the following particular for the assessment year previous year 1920. A salary computed, house property, business, that is non-speculative business. Okay, means a normal business, non-speculative. Then speculative business, short-term losses. Okay, so here they haven't bracket the amount even though it was loss. And long-term capital gain, so 19,000 is the gain. So short-term loss can be set off against the long-term gain. So 25,000 will be set off against the 19,000, and 6,000 will be carried forward. So this part is done, capital gain part. Then house property 24,000 will be set off against 45,000 rupees. 45,000 rupees. Perfect. Business loss of speculative can only be set off against speculative, so it will be carried forward. That is 4,000 will be carried forward. In the non-speculative, 22,000 can also be has to also be carried forward, because the income left is only the income of salary, and against that we cannot set off the business income. So we will see the solution of the 45,000. We can only deduct house property. Then 22,000 and 4,000 will be carried forward. Capital gain 19,000 minus 25,000, 6,000 will be carried forward. We will read the notes. Business loss cannot be carried forward, cannot be set off against the salary income. Therefore, the loss of 22,000 rupees from the speculative business cannot be set off against the income from the salary. Hence, such a loss to be carried forward to the next year for the set off against the business profit, if any. Note 2, loss from the loss of 4,000 rupees, so it will be carried forward. and it will be set off from the against the business profit of the next year. Note 2, loss of 4,000 rupees, that is speculative one from the speculative business, can only be set off against the income of the speculative business, and such loss to be has to be carried forward. Perfect. Has to be carried forward. Then third, short term capital loss can be set off against both short term capital gain and long term capital gain. Therefore the short term capital gain, short term capital loss of 25,000 rupees. So the short term capital loss of therefore the short term capital loss, therefore the short term capital loss of 25,000 can be set off against the gain of 19,000. The balance of short term capital loss of 6,000 can be set off can be cannot be set off against any other income, and has to be carried forward, has to be carried forward to the next year, and can be set off against the capital income. Perfect. We're done with two illustration number 3 is 3 number 3. Okay, here it is. Illustration number 3. During the previous year 1920, Mr. C has the following income for the income and the bought forward losses. Perfect. Short-term capital gain on the sale of the share. Bought forward loss. Bought forward long-term capital loss. So long-term capital loss can only be set off against long-term capital gain. So this we will keep aside. Short-term capital loss. This can be set off against the short-term capital gain. That is against 1,50,000 rupees. And long-term capital gain. Perfect. That 96,000 can be set off against this income, and the balance will be carried forward. It is most simplest question. 1,50,000 minus 37, short term, and this long term with 75,000 income is there, that can 96,000 can be set off against 75,000, and the balance, that is 96 minus 75, will be carried forward. Long term capital loss cannot be set off against the short term capital gain, hence the unadjusted long term capital loss of 21,000, that is 96 minus 75,000, has to be carried forward to the next assessment year and set off against the long term capital gain of that year. Perfect. We are done with 3 illustration number 4. Mr. D has the following income for the previous year 1920, which is the income 7 that is owning maintaining horse races 75,000 rupees. Textile business 85,000. Income from normal business, that is textile business 85,000 rupees. Bought forward from the textile loss 50,000 rupees. This 85 can be set off against this 50 can be set off against 85. Bought forward losses from the activity of the activity of the owning and maintaining of the races of the horse relating to the assessment year 1718, and this is previous and 1920. The owning and maintaining horse, the loss of owning and maintaining horse can be carried forward only for the 4 assessment years. So we have to count if it is relating to the assessment year 1718, so it can be carried forward for 1819, 1920, 2021, 2122, and this relates to previous and 1920 and assessment year 2021. So it falls within that 4 period, 4 year only. So it can be, this loss can be set off, means it haven't elapsed yet. So this 96,000 can be set off against 75, and the balance can be carried forward still for the period of one assessment year, 1920, 1819, 1920, 2021. Okay, till for one more further year it can be carried forward. So what is the total income in the hands of Mr. D assessment year? So 85 minus 50,000 over here, 85 minus 50,000, that is 35,000, and from the owning and maintaining 75,000 minus 96,000 means we can minus 96,000 minus 75,000 only, so it will be 0, and the 21,000 has to be carried forward for the can be carried forward for the loss from the owning and maintaining has to be carried forward for assessment year 2122. Perfect. Next year, that is loss from the activity of the owning and maintaining horse can be set off only against and cannot be set off against any other head of income. It can be set off only against that head of income, that is owning and maintaining of horse. Then illustration, we are done with 4. 5. E has the following Mrs. E has furnished the details of assessment year 2021 as under: salaried income 1,50,000 computed, speculation business 60,000 rupees. Non-speculation business 40,000. This only can be set off against the speculation income. Short-term capital gain 80,000 rupees. Long-term capital loss 30. It can only be set off against long-term. Winning and lotteries, this cannot be used for set off of any losses. Even though winnings loss cannot be set off against this 20,000 rupees. What is the taxable income? See, it is a much simple question. In this we are 1,50,000. From that we cannot deduct first of all any loss, so it will be taxable. Then speculation income from speculation business 60,000 rupees. Short term capital gain, loss of the non speculative business, this also cannot be set off. Winnings of lottery, oh, okay, I have read wrong. It is speculation business gain is there and non-speculative business loss is there. So this non-speculative business loss can be set off against the speculative income. Speculation business loss cannot be set off against can only be set off against speculation income. So in this case it will be set off 60,000 minus 40,000 rupees. I had read wrong actually. Speculation and non speculation, so it will be set off. Then capital gain 80,000 will be taxable. Winnings 20,000 will be taxable, and long term will be carried forward. Long term capital gain, so 80,000 20,000, and note for the long term capital gain, that long term capital loss can only be set off against the long term capital gain. Therefore the long term capital loss of 30,000 rupees is to be carried forward to the next assessment year. Perfect, we are done. Illustration number 6, compute the gross total income for the of Mr. F for the assessment year 2021 from the following information given below. Income from house property computed. Perfect. Business before providing of any depreciation. Okay. Short term capital gain on the sale of the share, it is a gain. Long term capital loss from the sale of the share brought forward from assessment year 17-18. It can only be set off against this loss can only be set off against long term capital gain income. Long term capital gain income from the tea business, that is income from the tea business, normal business, is 1,20,000 rupees. Dividend from the Indian company carrying on an agricultural operation. So the company is carrying agricultural operation, but in my hands dividend will be exempt. So dividend from an Indian company carrying agriculture operation, this won't be considered as an agriculture income, but this is a dividend is exempt under 10(1). Then current year depreciation, this we will deduct from the business income because that income was before providing of any depreciation. And brought forward business losses, loss incurred 6 years ago. Brought forward business loss can be carried forward. Business loss can be carried forward for 8 assessment year generally. So 6 year has been passed 6 year ago, so this can still be set off. So how this calculation would be done? 1 lakh, we will first write income from house property 1,25,000, then income from business 135 minus current year depreciation brought forward 45,000 rupees. So this 2 will be deducted. We will left with 64. From that, since it is a tea business, income from tea business 1,20,000 rupees. Income from tea business is 1,20,000. Since it is an agricultural business, tea, so 40 only income from. Okay, no. Sorry, I had mistaken. That was a different business of the from that 64,000 will be taxable, and in this case 1,20,000 income from tea business, 40% would be taxable and 60 is exempt. So 40% of 1,20,000 is 48,000. So 68 plus 64 plus 48 amounts to 1,12,000. This is the business income. Then capital gain income is only 56 because 90 will be carried forward. 56 and 90 will be carried forward. So we will see the notes. Dividend from the Indian company 80,000 is exempt under 1034. Perfect. 60,000 of the business in tea business is related to the agriculture income and therefore exempt from tax. Perfect. That we haven't added in the business income. We had only added 40%, and the other business income is wholly taxable, but that relating to the tea business is 40 and 60 we have to do, and long term capital loss can be carried forward against the long, can only be set off against the long term capital gain. Therefore the long term capital loss 90,000 rupees brought forward from 1718 can be set off in the assessment year 2021. It has to be carried forward for the, it has to be set off forward, it has to be carried forward and set off against the long term capital gain, if any, during the assessment year 2021. So for next year, if there is any capital gain, it will be set off. Okay, we are done with our illustration. How many exercise questions are there? 1, 2, 3, 4, 5. Okay, there. It won't take a long exercise. Till now we are 15 minutes are done. Exercise. X, carrying on the business as a sole proprietor, died on 31st March. Exercise part of the set off and carry forward chapter number 10. Question number 1 exercise. Question number 1, X, carrying on a business as a sole proprietor, on died on 31st March 2017. On his death, the same business was continued by the legal hire by forming a firm. As on 31st March 2019, a determined business loss of 5 lakh rupees is to be carried forward under the Income Tax Act. Does the firm consisting all the legal hire of Mr. X has the right to have his loss adjusted against a current income? Yes, they can carry forward because it is inherited loss. We will read the answer. Section 78(2) provides that where the person carrying on any business or the profession succeeded in any capacity by any another person otherwise than inheritance, the successor is not entitled. So if it is otherwise than inheritance, then successor is not entitled. In this case it is inheritance. So if it is without inheritance, then the successor is not entitled to carry forward and set off the losses of the precedor against his income. This implies that generally the set off of the loss can only be claimed by the person who had suffered the loss, and only exception to this provision is that the business passes on to the another person by inheritance. The fact of the case given in the question are similar to the case in CIT versus Madhukant, where the Supreme Court has held that if the business is succeeded by the inheritance, the legal hire are entitled to the benefit of any carry forward of the, if it is by inheritance, legal hire are entitled to the benefit of the carry forward of the losses of the precedor, even if the legal hire constituted themselves as a partnership firm. So even they have constituted a partnership firm, change in the constitution from the change in the entity, legal entity itself, from the sole proprietor business to partnership, the benefit of the carry forward and the setup of the losses of the precedor would be available to the firm. Will be available to the firm. In this case, the business of X was continued by his legal hire after his death by constituting a firm. Hence, the exception to this, the business of X was continued by after death by constituting a firm. Hence, the exception contained in 78 to the decision of the apex court would apply in this case. Therefore the firm is entitled to carry forward the business loss of 5 lakh rupees of X. So the business loss can be carried forward. The conclusion, then the conclusion is the business loss can be carried forward. Question number 2, ABC Limited has amalgamated with XYZ Limited as on 1/4/2019. All the conditions of 2(1)(b) are satisfied. ABC Limited has the following carry forward losses. Carry forward losses as assessed till assessment year 1920, that is previous year 1819, earlier previous year. Till that he had the following losses, that is speculative loss of 4. It can only be set off against speculative income. Unabsorbed depreciation against any income except income from salary, and unabsorbed expenditure of any capital nature on the scientific research can also be set off. Business loss 1 lakh, business loss 1 lakh 20 120 lakhs, and the XYZ Limited has computed a profit of XYZ Limited has computed a profit of 140 lakh rupees for the financial year 1920 before setting off of the eligible losses of ABC Limited, but after providing of any depreciation of 15% per annum on 150 lakh rupees being the consideration for which the plant and machinery were transferred to XYZ Limited. The written down value of the as per the income tax act as on 1st April 19 was 100 lakh rupees. So we will first add back this depreciation based on the calculation of 1 lakh 50, and we will then again provide for the depreciation as per the WDV as per the income tax act. The above profit of XYZ includes a speculative profit. So if there is a business loss, so business loss can be set off against speculative income. That is speculative profit, and if that is in that speculative profit is included in the business income, so it isn't any harm in the sense we can set off if there is any other loss. We can set off against other loss per se, business loss or other head can be set off against 10 lakh rupees. Compute the total income of AB's XYZ Limited for the assessment year 2021 and indicate the losses, other allowances to be carried forward by it. Business losses before setting off and brought forward of the losses of the ABC Limited 140, excess depreciation in the scheme of an amalgamation, so 150 minus 10, so 150 was as per books value of an asset minus WDV 50 was excess depreciation provided, so this will be added 50 lakh into 15%, 7.5 will be added. Then 50% depreciation because it is an plant and machinery. Then we had the earlier bought forward losses, this for speculative, then unabsorbed 18, expenditure on scientific 2, and business loss of 120. This all can be set off, that is but speculative can be set off only against speculative. So in this, the this 4 lakh cannot be set off because there isn't any speculative in no, I'm reading it wrong. 4 lakh speculative income, 4 lakh speculative loss, and we have the 8 lakh, 10 lakh speculative income. So first we will deduct, 120, that is business loss. Then set off of the business, set off of the unabsorbed depreciation as per 32 18. Then set off of the unabsorbed capital expenditure 2. uh, we haven't set off this speculative loss. See what is given in the note. It is presumed that the amalgamation is within the meaning of 42 72, okay, of the income tax act. In the case of an amalgamation, the unabsorbed losses and the unabsorbed depreciation of an amalgamating company can be deemed shall be deemed to be the loss of the unabsorbed, and shall be deemed to be the loss or the unabsorbed depreciation of an amalgamated company for the previous year in which the amalgamation was effected, and such a business loss can be and the unabsorbed depreciation shall be carried forward. Okay, it is a simple provision for the 8 assessment year, amalgamated for the period of 8 years, and identity and indefinite, sorry, in and for an indefinite respectively. Unabsorbed depreciation can be carried forward for indefinite period, and business loss for 8 years as per 70, as per section 72A7. And accumulated losses is to be carried forwards, accumulated losses to be carried forward, speculative specifically exclude the substanted in the speculative business. Therefore the speculative less of 4 lakh rupees ABC cannot be carried. Okay, so now what the concept, what section 72A states: in case of information, we can set off all the losses except the speculative loss. Hence we had carry forward only 120, that is business loss, 2 unabsorbed depreciation, and 18 unabsorbed depreciation, 2 for scientific research, but we haven't carried forward this 4 lakh rupees. So it is stated in 72A7. Section 72A provides that where the allowance or the part thereof of unabsorbed depreciation, section this much is to be carried forward, effect given is to the brought forward losses as per section 72. Means we can carry forward this unabsorbed depreciation thing, unabsorbed scientific research. Then section 35(4) provides that the provision of section 32 to relating to the unabsorbed depreciation shall apply in relation to the deduction under 35(1)(7) in respect of any capital expenditure on the scientific research by the assessee. Therefore, the unabsorbed capital expenditure can be set off and carried forward in the same manner as unabsorbed depreciation. So it is being carried forward and set off in the same manner as that of unabsorbed depreciation. The restriction under section 73 is only regarding the set off of the losses computed in respect of the speculative business. So there is restriction only in case of speculative. Such a loss can only be set off only against the profit of any another speculative business and not against non-speculation. However, there is no restriction under the Income Tax Act regarding set off of the normal business loss against the speculative. Therefore, the normal business loss can be set off against the profit of the speculative business. Consequently, there is no loss or allowances to be carried forward for assessment year by XYZ to the financial year 2020. There is no loss or the allowances because we had set off that three losses and unobserved depreciation and scientific research, and that 4 lakh rupees will be lapse. It can't be carried forward only. So there isn't any losses or unabsorbed depreciation left for carry forward. Illustration, we are done with 2. Illustration number 3, examine in brief about the treatment to be given in the following cases under the Income Tax Act. A loss of 85,000 was sustained by Simran in an activity of owning and maintaining of camel for a race. Okay, so it is given owning and maintaining of camel. So the actual provision states only in relation to owning and maintaining of horse. So the same provision is not applicable for owning and maintaining of the camel. Section 74A(3) lays down the provision of the set off and the carry forward of the losses of an activity owning and maintaining of the horse races. Accordingly, the provision of 73A(3) owning and maintaining of horse. Accordingly, the provision of section 74A(3) the loss incurred by an assessee in an activity of the owning and maintaining of the horse race cannot be set off against any income other than the owning and maintaining of the horse races. Since the scope in this section is confined to the owning and maintaining race horses only, therefore the set off and the carry forward of the activity of the owning and maintenance of the camel is not covered. So camel is not covered under 74A(3). It is possible to take a view that the loss of the activity of the owning and maintaining of the camel for the race may be governed by section 72, provided that such an activity amounts to business, that is business income. If that amounts to business, it can be set up as business income, business loss. Accordingly, the loss from the activity of the owning and maintaining of the camel for the race can be set off against any income other than the salary if it is considered as a business. So it can be set off against any income against except salary of the current year, and an unadjusted amount shall be carry forward and set off. And if any amount left unadjusted, it can be carry forward and set off carry forward for the maximum 8 assessment year immediately succeeding the assessment year in which the loss was incurred. So means pure next 8 assessment year we have to count. Illustration number 4, that is question number 4. Mrs. JKLM, a firm consists of 4 partner JKLM, that they shared profit and losses equally during 1920. The assessed business loss of the firm for the assessment year 1920, which it is entitled to carry forward amount of 3,60,000 rupees. A new sorry, I will read it again. The assessed business loss of the firm for the assessment year 1920, which is entitled to carry forward an amount of 3,60,000 rupees. The new deed of the partnership was executed among JKLM on 1/4/2019, in terms of which they agreed to share the profit and loss in the ratio of 15-15, 20-50 respectively. Compute the amount of any business loss relating to the assessment year 1920. So we have to compute the business loss relating to assessment year 1920, that is previous 18-19, which the firm is entitled to set off the business income entitled to set off against its business income for the assessment year 2021. That is as in previous year 1920, the business income for the firm for the business income of the firm for the assessment year 2021. So business income for assessment year 2021, that is previous year 1920, is 3,30,000. Your answer should be support the reason. So what the case exactly is. So, what is the summary of question 4 is there are four partners, and there are 2 years stated in the question, that is 1819 and 1920. In 1819 their share was equal, and in 1920 they had entered into new deed as on 1st April, that is starting itself for the ratio of 15 15 20 50, and accordingly the ratios has changed. There is a carry forward loss relating to the previous year 1819, 3,60,000 rupees, and there is an income of 3 lakh rupees in the current year. So what would be your answer? So answer: the firm is entitled to set off of its bought forward business loss of 3,60,000. So loss is 3,60,000 and current income is 3,30,000, relating to the assessment year to the extent of 3,30,000. Perfect. Loss, last year loss was 3,60,000, current year income is 3,30,000. It can be set off against the business income of 3,30,000 for the assessment year 2021. As per the provision, the balance of unabsorbed depreciation of unabsorbed business loss, which was being carried forward, is 30,000. Balance the 3,60,000 minus 3,30,000 relating to the assessment year 1920, that is previous 1819, will be carried forward to the assessment year 2021, that is the next year. Section 78(1), which deals with the carry forward of this and the set off of the losses in the stage of the change in the constitution of the firm, is applicable only where there is any retirement. Okay, section 78(1), which deals with the carry forward and the set off of the losses in case of change in the constitution of the firm, is applicable only where there is any retirement or death of the only where there is any retirement or death of the partner. So only if there is any retirement or death, but there isn't any retirement also in this case, and there isn't any death also, just the PSR has been changed, so that section 78 will not be attracted. It is not applicable to the case where the change in the ratio of the sharing profit and loss account amongst the existing partners. So therefore the section 78(1) is not applicable to the case of JKLM. We will read the last paragraph again. Section 78(1), which deals with the carry forward and the set off of the losses in case of any change in constitution. So only if there is a section it is attracted if there is any change in constitution, which is applicable only where there is any retirement or the death. So new constitution has been found, that leads to a change in constitution, but in this case there is only a change in PSR, so 78(1) will not be attracted. And last question, question number 5: an assessee sustained a loss under the income from house property in the previous year relevant to the assessment year 1920, that is 1819. That's sustained a loss which could not be set off against the income from any of the other heads in that assessment year. Okay, the assessee did not furnish the return of the loss. Okay, it is a house property loss and it cannot be sustained, but it cannot be set off against any income. The assessee did not furnish the loss return within time, and that is what within the time limit as specified under 139(1) in respect of any relevant assessment year. However, the assessee filed the return within the time allowed under 139(4), that is belated return. Can the assessee carry forward such loss for set off against the income from the house property for the assessment year 2021? Yes, they can, because the provision for the house property states that in case of house property and unabsorbed depreciation, even though the return is not filed on time, the loss can be carried forward. So we'll just go through the answer quickly. Section 139(1) stipulates that the assessee claiming any carry forward of the losses under the head of the profit and gain of the business and profession and capital gain should be furnished the loss return within time stipulated. There is no such reference for the house property under income from house property under 139(1). So there is only a restriction in case of income from business and profession capital gain, but not for income from house property. The assessee in the instance case has filed the return showing the loss of the house property within the time prescribed under 139(4), that is belated, not as per 139(1). Okay, the assessee is therefore entitled to carry forward of the loss for the set off. So for setting off, they can carry forward of the loss against the income from the house property of the house property of the subsequent assessment year. So this loss, even though return is not filed in time, it can be carry forward also and can be set off also against the house property of the subsequent assessment year. Thank you for watching the video.